Good morning, all of you. So, in last PPT or last video, we discuss start this topic as a depreciation and taxes. So, in this last video, we discuss about this depreciation term. So, for which property the depreciation we can consider, or which property we can depreciation consider. One more term, depletion, for the some some resources which are deteriorate after certain period of time. As time passes it deteriorate. For such cases the depreciation term is now considered as a depletion. That depreciation term considered as a depletion. And what are the major causes for the depreciations? That we discussed in the last video. So in this video we discuss further we discuss about the what are the objectives of that making provision for depreciation. What are the objectives? So that objective is nothing but that, as we earlier discussed, that recovery of the cost incurred on the fixed asset over the useful life. Recovery of the particular cost which incurred on the fixed asset over the particular useful life. So that we can keep that owner's capital remain intact. So as that, suppose after 10 years that particular property or particular physical assets reduce its value to zero. So during that particular 10 year, some provision we can made so that after 10 years that capital of that particular owners remain intact. And we can recover whatever that cost reduced during that 10 years of that particular property. Suppose that property having value 100 rupees at the beginning, after 10 years it have value 0. So that 100 rupees over the 10 years we can make some provision to recover that particular 100 rupees value over the 10 years. So such recovery of that cost incurred on the fixed assets is nothing. These are the objective of the provision of depreciations. So again, some replacement of old machines or old assets, we record some money, and that provision also we can get through the depreciations. So depreciation provision made, and we can purchase from that amount a new machine by replacing the older machines. Again, these are used to find out the actual cost of the production. Suppose 1000 products we produced, and for during production of the 1000 product, some amount we can apply for that particular process during the production of the 1000 product, that we can consider in the depreciation. So with gate or while using the depreciation, we can find out the actual cost or correct cost of the production. So some factors we are not considering. Suppose that machine deteriorations or other causes, machine deterioration, that we cannot consider during the cost of this production. Suppose after production of that 100 products, that machine is wear out. So after 100 product, we require to purchase a new machine. After 100 products, we will require to purchase new machine. So that cost of new machine, that must be we can distribute over this cost of this 100 product. So that now cost of that product now becomes as a also introduce that machine cost, because after 100 products, that machine we require that replacement of machine. So that cost we should also consider in the cost of the particular product. So it gives or it is used to find out the correct cost of the production. And another one is the find out correct profit for the year. So as we discussed with some one example, So after 3 years, suppose we require 100 rupees machine. After 3 years, that old machine now replaced or purchased by 100 rupees new machine. 100 rupees new machine. So that 100 rupees we should divide into that for 3 years. Suppose after 3 years we require to purchase new machine. So that 100 rupees cost of new machine it should be distributed during the 3 years. During the 3 years. So if you not consider this, during earlier years, so in earlier years that profit should shows or appear as a high, but at third year, at the end of the third year, that profit will reduce by 100 rupees. So at third year that profit of that firm is now showing less. So to find out the correct profit of that particular firm, that depreciation helps. And also that particular depreciation amount also reflect in that finance sheet. So it will give you correct financial position through balance sheet. So these are the objectives of that particular depreciation which we made. So major objective is provide some provision as that property asset have reduction in their value as time passes and as using that property or assets during a certain period of time. So that particular the reduction in their values that we should consider somewhere, and that consideration is the depreciation. These are some objectives of that depreciation. Now, another we can here also discuss that need for the depreciation. So to find out, as we discussed previously, to find out the true profit or loss, we need to consider the depreciation. As depreciation is loss, it should be considered for calculating true profit or loss. So this for true profit or loss, we should consider that depreciation. True cost of the production, as we discussed earlier, for 100, suppose 1000 product, after 1000 product we record to purchase machine. So that machine cost also we should consider, or we should distribute it among the 1000 product cost. We should distribute it among the 1000 product cost. So that the depreciation also find out the true cost of the production. So goods are produced with help of machinery, plants. Depreciation must be considered in the cost of production of the goods. True valuation of assets. So value of asset gradually decreases on account of depreciation. As account of depreciation, if the depreciation not considered, then the value of asset should be higher than its true value. Suppose that at the beginning that building have cost of suppose 100 rupees. So as time passes and as that building goes old, that cost of that building also reduces. And that reduction in that cost is considered by the depreciation. Reduction of cost is considered in depreciation. If we cannot consider depreciation, after some year that we can reflect that building cost is the same as at beginning. It is not possible. So that consideration is made by the depreciation. So this is the true valuation of assets. We require this depreciation term or depreciation concept. So replacement of asset. Now here again, as per discussion, that replacement of asset. Suppose that machine we want to replace after certain period of time. For that amount we should distribute over that machine's useful time, and that consideration is nothing but depreciation. So replacement of assets. That asset will be completely exhausted on account of use. So as that particular machine or asset we use, and that will be completely exhausted after a certain period of time. To purchase new assets or machine, we require some large amount, and that account may be considered from profit or by loan with saving some other assets. So that consideration will be made in the depreciation. Again, keep that capital intact. Whatever that capital invested by that owner, by that owner, that suppose 100 rupees, that owner invested 100 rupees to purchase a new building. So as time passes, after 10 years, that building cost is reduces as it become good, as it become good. That should be considered. That should be, so this gradual diminishes on account of depreciation, that also considered. And that loss of account of depreciation is, if you not consider this depreciation or decrease in that amount, that profit will show more. Suppose that profit or that asset value after some years, if you not consider the depreciation, that asset value remains same. So 100 rupees value or 100 rupees building value after some 10 years, that should not be 100 rupees. It should be reduced, and that reduction should not be reflect if you not consider the depreciation. If you not consider the depreciation. Now legal restrictions. Some legal restrictions are there. According to Company Act, you cannot give dividend. You cannot give dividend. Cannot declare that dividend without considering the depreciations. Without considering depreciation on the fixed asset. So you should consider depreciation on fixed asset. You should deduct the depreciation amount from your company's income, and whatever that remaining profit of that company, from that profit you can give dividend. You cannot ignore this depreciation amount. So these are some needs of the depreciation, some objectives of the depreciations. Now we move further. For the important terms that used in the depreciations. So some terms are used in the depreciation. So adjusted cost basis. This cost basis value adjusted for comparison of the depreciation deductions. Cost value which are adjusted, which we can adjust it for comparison of that depreciation deduction, that is called as the adjusted cost basis value. So second one, cost basis value. So it represents that initial cost. It represents initial cost of acquiring a particular asset. Initial cost of acquiring particular asset, which also include transportation charges and other charges also. Suppose some taxes, municipal taxes, that also considered in this cost basis value, so that after paying all the cost, that machine now you can use in your company. That is nothing but the cost basis value. So whatever that purchase value plus transportation value plus other taxes values, and after paying all the taxes and all these values, now that machine is reaching your company, and that you can use, or it is serviceable in your company. That total amount is nothing but a cost basis value. So it is the initial cost of acquiring that particular asset, considering all the other expenses, transportation expenses, other taxes, etc. So third one is the book value. So in this book value, this amount of capital that remain invested in the property and must be recovered in future through accounting process. So whatever that value that we can recover in future through accounting process, that book value at the end of K, we can say that adjusted cost basis minus the depreciation deduction. Suppose that 10 years, after 10 years, now for the what is the value after 10 years? What is the value of that particular asset? Now what is the value of that particular asset? Now what is the cost basis value? Previous cost basis value minus that the depreciation value for a particular period of time. Suppose that machine work having useful life of 20 years. Now we have to find out the value of that particular machine or 10 years after 10 years. Here that depreciation deduction for 10 years, whatever that amount that deducted from the cost adjusted cost basis value, and whatever that value remaining, which is nothing but the book value, which is nothing but the book value for that particular asset. So that is will be find out by adjusted value minus this depreciation value. Adjusted value minus this depreciation value, that we can find out the book value. Now fourth one is the market value. So this is the value of property. This is the value of property that paid by that willing buyer, to willing seller. That value of that property that is paid by that willing buyer to the willing seller, where both buyer and sellers don't have some force to buy that particular property or sell that particular property. So it is under no compulsion. It is under no compulsion of buyer and seller, whatever that value of that particular property which will be given by the buyer to the seller, which is nothing but a market value. Another one is the recovery period. So this period equal to the number of years over which that capital invested on property is recovered through accounting process. So whatever that number of years which required to get back that particular invested amount, that period which required to get that particular amount, is nothing but the recovery period. Through this accounting process. Now sixth one is the recovery rate. So to recover that whatever that capital invested during that recovery period, how much rate is required, or how much percentage is required is nothing but the recovery rate. So to recover or to get back that particular invested capital during that particular year or a particular year time of period, and at what rate we should for particular period of time, at what rate we should apply, which rate we should apply, so that we can recover that particular invested capital, that is nothing but the recovery rate. So that percentage, it is the percentage for each of the modified accelerated cost recovery system. So these are denoted by this MACRS short form. So that recovery period, how much percentage we required for particular recovery period to recover that capital invested due to the computer, and that are which we can utilize through this annual depreciation deduction, which we can utilize to compute that annual depreciation deduction. So to recover that particular amount for a particular period of time, how much we can apply some rate, recovery rate in terms of percentage, that is nothing but a recovery rate through this annual depreciation deduction. Now next one is the salvage value. So this salvage value, this is nothing but a estimated value of property at the end of its useful life. So at the end of its useful life, how much is the value of that particular property is nothing but the salvage value. So it is expected selling price of that particular property when asset can no longer be used efficiently by its owner. It is a selling price of that particular property when that particular owner cannot use it efficiently. That value is nothing but a salvage value. And last one is the useful life. So that it is a useful life is nothing but a expected period over which that property or asset can use efficiently and economically in that particular business, used efficiently or economically in that particular business. So that is the useful life of that particular property or particular asset. So these are some terms that are used in the depreciation. So this is adjusted cost basis value, cost basis value. So this adjusted cost basis value is nothing but adjusted cost basis value, which are used for the comparison of that depreciation deduction. Which are used for comparison of depreciation deduction. So book value is nothing but the adjusted cost basis minus the depreciation amount for a particular years. Suppose at 10 years, what will be the book value of that particular property, or what will the amount of that capital that remain invested in that property is nothing but the adjusted cost basis minus that is deduction for the particular years. So market value, recovery period. So recovery period nothing but that how much period we require to get back that whatever that capital invested in that business, that is nothing but recovery period, and which rate, at what rate we should get that particular invested amount get back. That is nothing but the recovery. Which we can express in percentage. Salvage value, that value at the end of the useful life of that particular property. And useful life is when that property work properly or efficiently and economically in that particular business, that particular period is nothing but useful life.